Hello dear CA final students, welcome to video number 4 where we'll be discussing case scenario number 16 to 20. So listen, NM Limited is an Ind-AS compliant multinational company which is engaged in various businesses. On 1st April 2011, NM Limited issues a new instrument with the following characteristics. Face value 100, issue price 90. Issues a new instrument. Okay. Face value 100, issue price 90. Cumulative dividend payable 5% per annum for 10 years. After 10 years, dividend is payable at the discretion of the issuer. Oh, when dividend is payable mandatory, then it is a liability component. But if dividend is payable discretionary, it becomes the characteristics of equity. Let's find out. The holder of the note has the option to convert to ordinary equity shares after 10 years. Conversion will be 10 ordinary shares for each instrument. The holder can demand redemption for the face value at any time with 6 months notice up to until end of 10 years. After 10 years, redemption is at the discretion of the issuer. Okay. There is no fixed maturity date. This is regarding NM Limited. S Limited is a subsidiary of H Limited, which is an associate of T. Okay. H Limited subsidiary is S, which is also an associate of T. T Limited is an associate of NM Limited. S Limited's functional currency and presentation currency is INR. Okay. While the functional currency of its parent is US dollar and its presentation currency is maybe euro. S Limited has a firm commitment to buy commodity in euro, which has entered into forward contract to hedge the firm commitment against foreign currency risk. It has to prepare its financial statements for the purpose of consolidation with its parent. Okay, so here what are the questions? How should instrument be classified by NM? In the first 10 years, in accordance with Ind AS 32, select which one of the following is correct. As equity, as liability, as either equity or liability, as compound financial instrument. What do you think? It is a compound financial instrument because initially at the time of issue itself, I need to divide it as equity and liability. Yes or no? After 10 years only I can exercise my conversion option, but still it should be recognized both as equity and liability because it's a convertible instrument. I hope it's okay. 2. Question number 2. How can S Limited account for a hedge relationship for the purpose of preparing H Limited CFS? We have studied that a hedge can be a cash flow hedge, fair value hedge, or net investment in foreign operation. So here there is no foreign operation. You don't have a foreign subsidiary. But here S Limited has a firm commitment to buy a commodity in euro. So here you have a firm commitment to buy something, then it is a cash flow hedge because a highly probable transaction or a firm commitment can result in cash flow hedge. At the same time, it has entered into forward contract to hedge the firm commitment against foreign exchange risk. Then the fair value of that item also needs to be protected. Whatever is the fair value, accordingly you have to make the payment. You have a firm commitment to buy something. The value of that commodity also can fluctuate and it will also result in outflow of cash. So the entity needs to decide whether it is a cash flow hedge or a fair value hedge. So here the entity has an option to designate under cash flow hedge or fair value hedge. Option C is the right answer. Okay. Now, how should NM Limited initially recognize the purchase of its machinery? What is given? It has purchased machinery worth 50 lakhs. Overhaul cost is 5 lakhs. Overhauling is once in 3 years and life of machinery is 10 years. So, what should be the option? Recognize machine 45 lakhs to be depreciated over 10 years and overall to be depreciated over 3 years. That should be the right answer. Yes or no? Option B. So option D, C and B. D, C, B. D. Compound financial instrument. Of course, I hope there is no doubt in it. Option C and option B. Case scenario number 70. A Limited is engaged in the manufacturing of certain specialized chemicals. During the manufacturing process, certain wastewater is produced which is released by A Limited in nearby river. In order to reduce pollution of the rivers, the state government has introduced a scheme with the following salient features. If a manufacturer installs certain pre-approved wastewater treatment plant, the government will provide an interest-free loan equal to 50% of cost of the plant. If interest-free loan, then you need to recognize loan at its fair value and the difference should be recognized as government grant in days with standard in days 20. Such loan will be repayable to the government in 5 years from the date of dispersal. Okay. The manufacturer availing benefit of the scheme must treat the wastewater of its factory using specified plan before releasing to the river. If the condition is violated, the entire loan shall become immediately repayable to the government along with penalty of 10 lakhs. Oh. Cost of wastewater treatment plant to be installed to avail the benefit of scheme is 50 lakhs. A Limited decided to utilize the scheme because if it were to obtain similar loan from a bank, it would be available at a market rate of interest of 12% per annum. Accordingly, A Limited applied for and obtained a government loan of 25 lakhs. A Limited purchased and installed the plant such that it became ready for use on the same date. A Limited has an accounting policy of recognizing government grant in relation to depreciable asset in proportion to the depreciation expense. It has determined that the plant will be depreciated over a period of 5 years using straight line method. What is the fair value of loan to be initially recorded in the book? So what we should do? So here it is an interest-free loan. So 25 lakhs needs to be repaid after 5 years. Market rate 12% for 5 years. 0.5674. 25 lakhs into 0.5674. 14 lakh 17,500. Option D, 14 lakh 17,500. What is the amount of grant to be initially recognized? 10 lakh 82,500. Option C. What is the amount of depreciation to be recognized for the year 2011-12 on waste treatment plant? Option A, 10 lakhs because 50 lakhs divided by 5 years. You are not adjusting grant to the value of asset. So 10 lakhs. What is the amount of grant income to be recognized in 11-12? So how much was the grant? 10 lakh 82,500 divided by 5. 2 lakh 16,500. Very easy, right? D, C, yes. Now case scenario number 18. See, case scenario number 18 is same as that of case scenario number 17. See, A Limited is engaged in manufacturing of specialized chemicals. During the manufacturing process, wastewater is produced. Everything is same. Line by line, it is the same. So I'm not reading. I don't want to waste your time. See here, all it's the same. 50 lakhs, 12% loan, 25 lakhs. A Limited has an accounting policy of recognizing government grant in relation to depreciable asset in proportion to depreciation expense. It has determined that the plan will be depreciated over 5 years using straight line method. Up to this, it is the same question. Then what is the difference? In the month of March, okay, March 2013, so after 2 years, government officials conducted a surprise audit and it was found that A Limited was not using the water treatment plant as prescribed. Accordingly, on 31st March 2013, the government ordered A Limited to repay the entire loan along with penalty. A Limited repaid the loan with interest and penalty as per 31st March 2013. Okay, so here there is a refund with a penalty. So first question, the grant becomes repayable should be accounted as change in accounting estimate. Should be accounted as, if it is repayable, refundable, it should be accounted as change in accounting estimate. What is the amount of finance cost to be recognized in the books for the year 2011, 12 and 12, 13? So finance cost is, loan is initially recognized at what value? Fair value of loan was 14 lakh 17,500. Lakh 17,500 into 12 percentage, 1 lakh 70,100 and must be 190,512 plus 12 percentage. Option A. Option A. We calculated 14 lakh 17,500 into 12 percentages first year interest 1 lakh 70,100. Then again we tried plus 1 lakh 70,100 into 12 percentage, it is 190,512. Option A. So here option B, here option A. What is the amount that becomes repayable to government on revocation of grant on 31st March 2013? What is the amount to be repaid? 25 lakhs plus 10 lakhs. 35 lakhs, 25 lakhs plus 10 lakhs penalty. What is the balance of deferred grant income accounted on 31st March 13 after crediting grant income for 12/13? So how much was the grant income? It was 10 lakh 82,500. This 10 lakh 82,500. So let me check the previous question. First year 2 lakh 16,500. 10 lakh 82,500 minus 2 lakh 16,500 minus 2 lakh 16,500. The balance should be 6 lakh 49,500, right? It should be option D, right? Option D. This was the balance. Now, on refund of grant, out of grant 25 lakhs, what amount of grant income to be debited to P&L? So, upon refund, what is the journal entry? There is a loan balance, there is a grant, deferred grant balance, and there is P&L loss to bank 25 lakhs. They are asking specifically for 25 lakhs. How much loan will be debited? Loan balance. It was originally 14 lakh 17,500. So 14 lakh 17,500 plus 12 percentage. Year ending balance is 15 lakh 87,600. So 15 lakh 87,600 plus 12 percentage. There is no repayment. 17 lakh 78,112. 17 lakh 78,112 is the loan account balance. Grant account balance is 10 lakh 82,500 minus 2 lakh 16,500 minus 2 lakh 16,500. It is 6 lakh 49,500 is the grant account balance. So we need to take the total 72. We got that figure 72,388 is the amount to be charged to P&L. What will be the total impact to P&L account on revocation of government grant? This and also a penalty. So 10 lakh 72,388 option B. Okay. So case scenario number 19. FF Limited is into manufacturing and retailing of FMCG products listed on stock exchanges in India. The company and its one of subsidiaries have entered into various transactions, the accounting of which needs to be analyzed in detail from the perspective of India's implications. You being an India's expert, CFO of the company have appointed you to analyze the transaction based on the following details. Company has entered into a lease agreement for its retail store as on 1st April 2012 for a period of 10 years. A lease rental of 56,000 per annum is payable in arrears. Okay, in arrears means end of each year. Company recognized a lease liability of 3,51,613 at the inception using an incremental borrowing rate of 9.5 percentage. Okay, so IRR is not determinable. Maybe that is the reason they have gone for IBR. As per the terms of lease agreement, the lease rentals shall be adjusted every 2 years to give effect of inflation. Okay. Inflation cost index as notified by income tax department shall be used to derive the lease payments. The inflation cost was 280 for 12/13 and 301 for 14/15. Current IBR is 8 percentage. Okay. See here, this is on Ind AS 116. The next one is on Ind AS 12. And the next one is on Ind AS 102. So after reading this, in exam also after reading one paragraph, if the next paragraph is talking about something else, please turn to next page and find what is the MCQ on it. So here I am finding out which of the following statements correctly describe accounting of lease arrangement of the retail store. How much is increase in lease liability is the question actually. So we need to calculate. I need to find out 56,000 was the lease rental for 12/13. But 12/13 inflation cost was 280 and now it is 301. So how will I find out the new lease rental? 56,000 divided by 280 into 301. So new lease rental will be 60,200. Is this the question? What is a new lease rental? No, that is not the question. Company has already recognized the lease liability of 3,51,613, and the inflation cost has changed. So here, and they have given new IBR. What have you studied at the time of remeasurement? If the remeasurement is just changing the lease payments, and if the remeasurement is changing guaranteed residual value and lease payments, you should use original IBR or IRR. So here what I have to do is, opening was 3,51,613. I'll be unwinding it at 3,51,613 into 9.5 percentage, 33,403. How much you would have paid? 56,000. So you're ending 3,51,613 plus 33, 3,51,613 plus 33,403 minus 56,000. Closing balance is 3,29,060. Okay. So here next year also, because as per the terms of the lease agreement, the lease rentals shall be adjusted every 2 years. So after 2 years only there is a change. So this is the balance at the end of first year. Second year plus 9.5 percentage minus 56,000. So it is 3,04,273 is the balance. 3,04,273 is the current lease liability balance before change. It is the current lease liability balance before change. Now, what is the new lease liability balance? Originally, it was for 10 years. Now, 2 years expired means it is 8 years now. And my new lease liability is 6,200. So, what I should do? 1 divided by 1.095. 1, 2, 3, 4, 5, 6, 7, 8. So 5.4334. 5.4334 into 6,200, it is 3,27,091. So 3,27,091 minus 3,04,273, 22,818. 22,818, 22,820. With corresponding increase to P&L. What is the entry? Lease liability increases means ROU asset to be increased. So 22,820 should be the option B should be the right answer. First, lease liability they have given. So year 2 closing balance I need to find out. Then I've calculated 6,200 into annuity factor at 9.5 percentage for 8 years, because if there is just change in lease payments and guaranteed residual value, IBR or IRR, originally what you have taken should not change. So difference we have taken, and this is my entry will be ROU asset to lease liability. Now, Vikash Retail Private Limited, a subsidiary of the company, had suffered heavy losses in the previous periods. These losses are accumulated and eligible for set-off from future taxable income while calculating tax liabilities for future periods. However, no convincing evidence available which conveys that sufficient taxable profits will be available against which tax losses can be utilized. So this is on Ind AS 12. So what is the question on it? What shall be the right accounting of tax losses accumulated? The entity shall not recognize DTA. It shall recognize DTA. Wrong. It cannot recognize DTA. It shall not recognize DTA, not disclose. We can make the disclosure. It shall not recognize DTA, but it cannot, nor it shall disclose. But it should make the disclosure. There is carry forward losses, but DTA is not created. And what are the reasons you can disclose? The entity shall not recognize DTA, however, it shall disclose and period by which it expires. This is the right answer. Option C is the right answer. Then 3, 4, 5. 3, 4, 5. The company has also launched a share-based payment plan, which it will grant SAR to its employees, stock appreciation rights, cash settled plan. Vikash Retail Private Limited, as per the terms of the plan, the company, the parent, will pay an amount per SAR, which is the difference between current stock price of the company and stock price of the company after 3 years. Of course, the amount will be paid by the company directly to those employees of the subsidiary who complete 3 years. So a parent will be giving cash to the employees of subsidiary to ensure the availability of funds at the time of settlement. The company purchases its own shares from the open market. The company will sell these shares after 3 years to pay cash. What shall be the accounting treatment of share appreciation rights given in standalone financial statements of parent and subsidiary? Very good question. So what should be the accounting entry in the books of parent company? Parent company accounting is investment in subsidiary to share-based payment liability. For parent, investment in subsidiary to share-based payment liability. And in the books of subsidiary, the entry should be, for subsidiary, there is no cash outflow. For subsidiary, there is no cash outflow. So subsidiary should account it as employee benefit expense to capital contribution from parent. For subsidiary, it is an equity transaction. But for parent, it is a liability transaction. So what is this? Parent and subsidiary both shall account it as equity settled. No. Parent shall account it as cash settled with corresponding debit to investment. Correct. Subsidiary will account it as equity settled share-based transaction with corresponding credit to equity. Pakka. This is the right answer. Because for subsidiary, there is no cash outflow. So subsidiary will account it as an equity transaction. Parent shall account it as equity. No. Parent and subsidiary. No. So option B is the right answer. So which of the following statement is correct for calculation of earnings per share? Oh, that we have not read. That adjustment we have not seen. The company has issued equity share capital of 1 crore divided into 10 lakhs equity shares of rupees 10 each. Okay. As of 1st June 2013, the company had issued 3,60,000 convertible warrants of rupees 10 each. 6 warrants will be converted into 1 equity share of the company at the end of 18 months from the issue date. Warrants will not be redeemed. Warrants will not be redeemed, which means these warrants should be converted into equity shares. So here, what is the question? So 3,60,000 warrants are issued and 6 warrants will be converted into 1 equity share. So 3,60,000 divided by 660,000 shares are to be issued. But it is mandatorily issuable. Warrants will not be redeemed means these shares are mandatorily issuable after 18 months. So what is the question? Which of the following statement is correct for calculation of EPS? See, if there are optionally convertible shares, mandatorily convertible shares. What is the rule of mandatorily convertible shares? Mandatorily convertible shares should be considered in basic EPS from the date of date of contract. From the date of contract onwards, mandatorily convertible shares should be included, which means what is the date of this 1st June 2013 means 60,000 into April May. 10 by 12. 50,000. So correct answer is 10,50,000 shares should be used as denominator for calculation of basic and diluted. Because in case of this mandatorily convertible shares, it should be considered as issued from the date of that contract onwards. Not the actual issue, but date of the contract onwards. Okay. Now, how should the company account for amount invested in own shares? See, for SAR scheme, the company has invested in own equity share. When you invest in own equity shares, it should be recognized or identified as treasury shares, and this will be recognized. It will not be shown as investment. It will be shown as a reduction from the equity. When you invest in your own shares, it should be treated as a reduction from the shareholders' funds. From the equity, you should show as a reduction. Equity to bank will be the journal entry. Equity to bank. And any gain or loss upon sale will also be recognized in equity. So here company shall recognize the amount invested as investments in equity shares. Wrong. The company shall reduce the amount invested from equity. Any gain or loss also will be directly invested in equity. Option B. Either A or B. No. Company shall recognize as investment. This is no. Option B. Very good question. Okay. Case scenario number 20. HS Limited, the company is a car manufacturing company. During the year, the company has contracted into many transactions, details of which are given below. Finance control of HS Limited requires your assistance in determining the accounting treatment of these transactions in accordance with Ind AS. During the year, the company has issued compulsory convertible debentures on a private placement for 100 lakhs. Each CCD is convertible into 5 shares at the end of 4 years from the date of issue, and an annual interest is payable at the rate of 6%. Initial recognition of the company has recognized a liability component of, I think, a similar question we did before, 20 lakhs 79. 63, 100 lakhs is the total value. So this is liability. Yes. Company has recognized expense of 2 lakhs. Transaction cost, I think the same, very same, similar question we have done before. So anyway, 20 lakh 79,063. So 79 lakh 2937 is the equity component. And 2 lakhs transaction cost should be allocated in this ratio. So 2 lakhs into 20 lakh 79,063. So to the liability we should recognize 41,581. So 41,581 minus 2 lakhs. To equity 1 lakh 58,419. Okay, what is the question? This is not the one. Oh, the same question. What shall be the accounting treatment of 2 lakhs? Option C. Yes. Now the company has acquired 40% stake in NM Limited for 8 lakhs. Okay, so equity. As at 1st October, the carrying value, fair value. This one also we have done. So carrying value is 3 lakhs and fair value is 5 lakhs. So there is a gain, fair value gain of 2 lakhs. And profit earned is 50,000. So 50,000 into 40 percentage. 20,000 is to be added, and additional depreciation of 2 lakhs in 2 lakhs divided by 20 quarters. So 1 quarter we'll get into 40 percentage, 4,000. So 8 lakh 16,000. Oh, same. So it's a repetitive one. So that's it, guys. So I'll quickly do the next video. See, I'm having regular class now. So after class only I'll be able to do. That is why I'm limiting to 5 scenarios. In the last scenario, there was a comment. Please do 10 scenarios in a video. But it is, I'm finding time. I have to find time. So I'll do it soon. Okay. Thank you for watching, and we'll meet in the next video.